Okay, we're going to start chapter 6, the first of several chapters talking about common stocks and how we analyze, ultimately how we can determine the value of stocks. So let's go ahead and get started. I mean, obviously, what are common stocks? What do they do, right? Essentially, they're a piece of paper that identifies partial ownership, right? So the term that we're looking at is equity, right? You are an owner of the company. Now, this claim is not a claim without some limits, right? There are some things that you ultimately don't get because of the nature of this ownership, right? But we're typically referred to common shareholders as residual owners. There's really no guarantee of what you get at all. If there's anything left over, then that distribution can be given to the shareholder. So stocks are very nice in that they let us tailor our investments to some needs and preferences. They can provide income for us, and certainly they can increase in value over time. And ultimately, that's sort of why we want to buy them, right? We want to have a method or a tool that can help us to increase our wealth. So when the stock market is strong, right, obviously we're thinking that there's good times at play, then you could count on some price appreciation. Of course, the other thing happens when markets falter, right? When the markets are falling, stock prices are falling. So over the last 118 years, it's said here that the Dow Jones Industrial Average has dropped just 40 times. So less than half of the time. 2/3 of the time, the stock market was up from less than a point to nearly 82% on the year. So the volatility, the changes that we see are there. However, a vast majority of the time, we're going to see increases in stock markets rather than decreases, right? So obviously there is an opportunity here that I think some people misunderstand when they think about stocks and the stock market. Big returns obviously happen to come from capital gains rather than dividends. What we will ultimately find out if you talk to companies in general is most of the times dividends are fairly not consistent. They're not always the same, but dividends are almost always there. So there's always some rate of return that you can expect if a company is actually paying dividends. From 1930 to 2014, the average rate of return in the S&P 500 was 11.4%. In 2008, actually lost 36% in 1 year. From 2000 to 2009, there was only an average rate of return of about 1.1%. So for the last decade or so, the markets have been very volatile and the growth has been rather slow. However, as of lately, the markets are on the move. If you've been looking over the last couple of years, the stock market has had some extreme highs, extreme lows. And on this date, which is August 20th, we've been seeing in the last couple of weeks that the stock indexes, the primary indexes, the S&P 500, the NASDAQ, and the Dow have all been hitting record highs. So average market performance gives us a benchmark to measure by. But we also obviously have to be careful. We have to understand what it is that we're investing in and how that's supposed to react and how we're supposed to react, I guess. So here's, again, just a little bit of a picture. You can see here that every decade, every time frame that they have shows that the stock markets have an ability to make money, right? So we actually have returns on dividends every time. So there are certain years where there's some negative returns and negative time frames. But in general, over the long haul, we're going to see a positive rate of return when you invest in stocks in the stock market. What happens to real estate typically is what happens to the stock market. These two are very closely related to each other, mostly because the real estate market is directly tied to the economy. Whatever's happening in the economy obviously flows to the companies and therefore to the stocks of the companies. So we see obviously that home prices dropped dramatically summer of 2009. Lots of people lost a lot of value in their homes. That decline slowed down the housing industry in general, both building, renting, etc. And the economy fell into a recession. With that recession, what naturally happened to stocks then was that the stock market fell right along with it. There's actually an index that is frequently used. It's called the CaseShiller Home Price Index. And what you can see is that this index has a tendency to follow. Here's the average home price. That's that index, is the blue line. And wherever that blue line goes, it seems or tends that the stock market seems to follow with it. So there's a relationship between the stock index and this home price index, that they are related to each other. Whether they're above or below each other, quite frankly, isn't necessarily the most important piece of information. What we need to understand is that they are related, that one can tell us a story about the other. So what is it that stocks have to offer, right? We have an opportunity for some returns. They could be substantial. Stocks are typically going to outperform bonds, sometimes by a great deal. They can provide some protection against inflation. They're easy to buy and sell. The costs of trading, the commissions, etc., are typically modest, right? The information about investments is pretty easy to find. And actually, for many, many stocks, the per cost share is low enough that lots of people can afford to buy them. The primary disadvantages, though, are really about the risk, right? There's risk with the businesses. There's risk in how the businesses finance themselves. There's inflation risk, right? The stock returns in general are volatile. They change up and down. Sometimes, many times in a day, they'll go positive and negative. And in general, stocks have a tendency to distribute less current income compared to alternative investments. But for most people, that's not why you buy stocks. You buy stocks for prices, not necessarily current income. So even though stocks pay lower dividends relative to what maybe bonds might pay, they have the additional aspect of having price appreciation, which obviously adds to that. So if you kind of think about the income, right? Bonds have a higher income distribution than stocks do. But to stocks, to this dividend yield here, you also then have to add the return. So when you add the return, it takes the total return of stocks up above what it is for bonds. So next, some just basic characteristics. Coming back and talking about the general security itself. Every share represents ownership, right? Ownership and equity. That's what equity means, right? So as a corporate security, stocks can be publicly traded. That means they're there for you and I to be able to go out and purchase whenever we want. So how does that happen? How are shares actually distributed? We can get a couple of ways. One way primarily is through what's called a public offering. The company decides that it wants to issue stocks, new stocks, to brand new investors so they can issue shares to public, to us. They also have what's referred to as a rights offering. This is where they don't necessarily want to give stock to new investors. They are going to offer shares of stock to existing shareholders. Each shareholder is going to get the right to purchase a certain number of shares based on their ownership position. Now, of course, in the end, if the company can't sell all the shares they want through this rights offering, the remaining shares that they need may also then be issued to the public, right? So in the end, the basic idea is the same. The company needs some money, and they're either going to get it all from old shareholders, or they're going to issue it to the public and get it from new shareholders. What is a stock spin-off? Maybe we have a division that for some reason or another, we don't want that division in our company anymore. So we want to create another company. So we're going to convert this division, if you will, to a standalone company by distributing stocks for this new company, right? So there have been several of these out there. They have some examples of these. You may or may not have ever even heard of some of these companies, but certainly Land's End is a clothing company. TripAdvisor is part of Expedia, right? The online internet travel type of a mechanism that you can use, right? But typically, we're going to spin these companies off if we just don't seem they fit anymore, or if we just don't like the way their products are mixing with our current products, right? So again, it's a strategic decision to try to figure out how to better manage what it is we do as a business. Now, a stock split is a little different. This is where we're just going to change the number of shares that are available for our specific company. So an example, in a 2-for-1 split, every shareholder is going to get 2 new shares for every old share that they own. A 3-for-2, they get 3 new shares for every 2 that they own. Typically, the reason for doing this is to get the price to a place that's more attractive for investors. It's more affordable. So as you see here, the example for Starbucks, they did a 2-for-1 split. The stock was selling for $95, and then the day after the split, it was then selling for $47, roughly about half of what it was the day prior to the split. So this is just a way for us to get, it's kind of a marketing game in order to try to get the stock to a place where more people can be interested in buying it. Treasury stock is really not an investment kind of category. Treasury stock is stock that's been repurchased by the company, right? The company decides, for one reason or another, that they want to buy stock back from the public. So when they buy back this stock, typically what they're saying is they think that this stock is undervalued. It's a good buy. So they're going to buy it at what they perceive as currently a low price. They can also do this as an alternative for dividends. They can do this for other corporate strategy reasons. They could use it so that they could pay stock options to their employees. They could do this if they wanted to buy another company, right? So the short-term impact, once we see companies that, if companies are buying back stock, that's usually a positive sign, and stock prices will typically tend to grow a little when a company repurchases shares. Another characteristic of stock, and again, not all that prevalent, right? You don't see them everywhere, but we talk about something called classified common stock. And what classified common stock basically is one company has more than one kind of share. Now, what's the differences between the shares? The differences could be differences in dividends, but it also could be differences in voting rights. And they talk about here with the Facebook IPO, there were 2 classes. Class A shares were entitled to 1 vote per share, But Class B shares were entitled to 10 votes per share. So the original Facebook CEO and those other insiders, they have shares of stock, but their power in the company when it comes to voting for things is far more than what it is to the public. There's also, this is also done by families. The core stock, TAP, TAP, we'll talk about in class from time to time. You know, half of the stock is, they have two classes. One class is owned by the Coors and Molson family. Everything else is bought by the public. There's also some differences in stock with respect to preferred stock and common stock. Some companies, the families own preferred stock and everybody else owns common stock. But there's really no difference other than different types of activities or benefits go along with those classes of stocks. So what about reading quotes, right? What does a stock quote tell us, right? As first definition, let's think about what market capitalization means. Market capitalization tells me the number of shares of stock times the share price. It gives me the total. If you wanted to buy every single stock that was ever issued, how much would you have to pay? Now what we can find, and we're going to look at this as we get to class, we're going to go out to Yahoo Finance and we're going to look at this kind of information for a company, right? So here's a stock quote for Abercrombie and Fitch. Here's the current price, all right, was trading. This is after hours, so there's no more trading going on, right? But the last price that traded was $21.42, and that's up 0.8% for the day. Here's the company's name, obviously. Here's their ticker symbol. Yesterday's close was $21.25. So it's up a couple of cents, 17 cents from yesterday. Today it opened to $21.27. We're going to talk a lot about some of these other statistics. The 52-week range, right? 52 weeks ago, or sometime in the last 52 weeks, it was as low as $19.34, and it's been as high as $45.50. So there's been a pretty big range that we're right about in the middle. We can talk about earnings for the company. Tells me this company is paying dividends, and the percentage returns on the dividends that a person gets is here. 3.7% is the rate of return on Abercrombie and Fitch just for owning the dividends. Then we also have to take into account price appreciation, right? That's the total return. So let's continue on. Common stock values. There's something called par value and book value. Par value is just an arbitrary number. It's really just an accounting term. It's essentially useless from an investor perspective. The book value of a company basically tells me the accounting value of the company. It's kind of a backward look at what the company is worth, and it's a historical designation, right? So it really has nothing to do with the current value of the company. Market value is the number we're obviously most interested in. Market value is assumed to be forward-looking. It reflects how people think about the stock. If the stock price is going up, people are optimistic, they're buying, demand for the stock is increasing, and the stock price goes up. Typically, stock prices will be higher than their book values, right? So if the stock price actually falls below its book value, really there could be some very big problems, and maybe we might not want to necessarily invest in those companies. So market value is what you have to pay to buy this. And again, it reflects what investors are thinking about the stock. But now let's ask, what is this thing called investment value? Investment value is what I, as an individual, think it's worth. And this is how the stock game works. The market price is what you have to pay based on what the rest of the world thinks the stock is worth, right? The supply and demand mechanism creates this price. However, I'm going to be gathering information. I'm going to be analyzing, and I'm going to come to my own conclusion about what I think it's worth. We're going to have a whole chapter where we talk about ways that you can determine what the stock is worth. And again, it's your opinion, right? So there's a complex process. We have to talk about risks. Again, we've already talked about risk. We have to talk about risk. We have to talk about value, right? We have to find out what's the maximum price that you as an investor would be willing to pay for that issue. So that's the end of part 2, or part 1, excuse me. Part 2 is on its way.